let's now segue into investments. And of course, when it comes to investment, you're super guru. Recently, you wrote an article. Okay. I feel it's like slapping my face about S&P 500.
I never. It was not meant to be like that.
I can imagine. It's like Lu Cheng Chuan. You tell people buy S&P 500. It's like that. But anyway, you wrote an article about warning people about I'm trying to use over believing S&P 500. Okay, that seems to go against the grain of what people are now more familiar with. Warren Buffett also say S&P 500, and a lot of other guru. I also S&P 500. You may care to explain a little bit why.
We are good partners. I cannot get people to invest. You got them to invest, and after they have invested, I warn them from just over concentrating on one asset class. And I know you don't mean that. I don't mean that go invest S&P 500 and do nothing else.
Yep.
Right? You're just advocating an index, which is not wrong. I believe in that. I've got S&P 500 index.
How much?
It's I don't know how much.
Percent?
It's a small percentage because my main investment portfolio is with my company's portfolio.
Oh.
It's 100% dimensional.
Okay.
Okay, and then my exposure index.
Dimension also very good, but very difficult to buy.
Yeah, but
it's not. I don't buy. 金康靠背. Yeah, it's
the
last time
company
very
that
difficult.
you invest in got sell now, so not difficult.
I bought Dimension from him.
But now not so difficult lah.
Now not so. Okay, we'll talk about that later. Okay.
Yeah. So anyway, what was I saying? I was saying that I've got an index exposure as well, and my index exposure is I've got MSCI All Country. I have got one ETF that tracks small companies. And then I've got S&P 500. So I do that as well. But I think what people need to realize, which I'm trying to say, is don't just buy one S&P 500 and think that gao tim already. It is not a silver bullet. Why so? Because there have been in history periods whereby the S&P 500 firstly gave flat returns.
Lost decade.
Yeah. And there have been periods whereby the S&P 500 gave negative returns for 23 months, right? Now, you and me, if we understand, in that 23 months, we don't care.
Yeah, I don't care.
You stay invested.
Go fishing, go do a work, go skincare.
Or you may even buy some. When the market drops, you may even buy some more, right? Yeah. But the two problems here is that if a person firstly just depends solely on S&P 500, and if they need money during that lost decade, they're in trouble. Yeah, they're in trouble.
Yep.
Why did Warren Buffett say invest in the S&P 500? Because Warren Buffett has no time horizon. He invests for life. He doesn't care, right? Because he's not investing for himself. He doesn't need the money, right?
Sure.
But most of the people who listen to us, they may need the money in 10 years' time, 15 years' time.
Fair.
And if that period is the lost decade, they are going to hate us for telling them just to do that, right?
That's a good point.
That's the first thing. The second thing is that not many people understand investing, and if they see the S&P 500 index going down for 12 months, 24 months,
老久.
they may sell.
Yeah.
And the minute they sell,
it goes up.
Is the end already.
Yeah.
They're not going to reap the rewards of staying invested.
Sure.
Right? So effectively what I'm trying to say is that it's not a silver bullet. Don't just invest in one. Be more diversified so that firstly, when the S&P is not performing, you can stay invested. Secondly, if you need the money during that lost decade, your other investment can make up for it. So that's what I mean. I'm not against it. I'm just saying be a bit more diversified.
Okay. So I think that's a good point. Okay, first of all, I also caveat. I always say I don't have more than, 15-20% S&P 500. I always tell people, I cannot tell people, he can because I think he got license. I cannot tell people you should buy S&P 500. Okay?
15%, that's about 15 million already.
15%
of your portfolio.
Okay, anyway, so my
you
point...
got 2% with me only.
So anyway, he always like that one. Okay, anyway, so I think the key thing is this. I cannot tell you to buy, but only a portion of it is in S&P 500. I got CPF, I got some other stuff, I got businesses. My business very small relatively, but I still got businesses and things like that. All ham into S&P 500, I also don't have the guts to do it. Okay, so what he say, I completely buy it. But that goes to the next topic. Then put what? Just like you mentioned, Dimension Fund, MSCI World Index, all these. But those also got very big exposure to US, right?
Yeah, I mean,
so when S&P 500 go down, they also go down.
yeah. So it is without doubt that the US stock market constitute about 60% of the world stock market in terms of market capitalization. So even when you invest into the MSCI All Country World Index, about 60% exposure to it, you cannot run away because US is the biggest market, right?
Yeah.
But at least you got 40% in other developed markets and emerging markets, right? That makes the volatility not too bad, right? So at least you can get some returns. And we are just talking about equities only. There are people whom are also investing in bonds, right? So you can get returns elsewhere. So in short, don't just put all your eggs in one basket. I mean, it's nothing new. Everybody know this phrase, right? And the other thing that sometimes we worry about is that I know the S&P 500 has had a good run since 1926.
Yep.
I'm not sure whether the next 10, 20 years, the returns will be like that.
Okay.
We are almost the same generation. You remember the 1990s.
Oh, of course.
Buy anything, you make money.
Yeah,
in the 1990s, if there's an IPO in Singapore, you just buy. You don't even care. You just buy.
Anything makes money.
You make money.
Yeah.
The S&P 500 annualized easily gives you about 13%.
Okay.
Today, can we still assume that the S&P 500 will give you that kind of returns? Will US be the same US as it has been over the last almost 100 years? We don't know, right? So it's a bit scary. Just put everything into US.
Okay, fair.
Right? So I would say to give you the highest probability of success, be a bit diversified. The thing about diversification is that you are not going to get the best return. But if that return that you get is enough to fund your lifestyle, then just be contented.
Okay, very fair. I saw you have some interesting news on dimensional fund that now you can buy using your CPF. How does it work?
So,
again, small time customer and me cannot go, cannot man the street come and look for a Provident and buy $10,000 of dimension fund, right?
Yeah. I mean, can I mean, come to us.
Yeah.
You don't have to come to us.
It means cannot lah.
Yeah.
Okay. Yeah,
I mean,
but there are other places we can buy, is it?
Yeah, there are plenty of places you can buy. I mean, you can buy from if you want to DIY, you can buy from Endowers, right? They are the robos that does it. There are other FAs who are also using, and I mean, we are not the only people using Dimensional. There are other financial advisor representatives that also can use Dimensional.
Using OA. CPF.
Yeah, can.
Oh,
can, yes.
That's a new thing.
Yeah, can. Everybody can.
Oh,
I mean, what
that's a great news.
Yeah. So if you prefer to speak to an advisor and you find us not suitable for you, then you can always speak to other people. If you are the kind that want to speak to a human being, you rather go on a computer and just buy on your own, you can. The only robo that does it is Endowers because they have the CPFIS, right? But there are two things I want to say. Right. Firstly, should everybody invest their OA? I'm not sure everybody should invest their OA. Right? Why? For the man in the street, if you don't have other assets, okay, to help you get to your objective, the only source of funds that you have is monies in your ordinary account. And you understand investing, you can take the volatility risk. Fair. Use your OA. Because that is going to beat the 2.5 and get you to where you are.
Sure.
For you and me, I mean, I'm nowhere near your wealth.
But, come on.
But you got 100 million obo. Yeah,
100 million. The number get bigger and bigger every time.
I've been sticking on 100 million since the start of the
next one you're going to say Mr. Lu at 1 billion.
So basically, our OA money is like a good bond.
But 2.5%, okay, also better than nothing.
Not bad. And you have cash.
Yep.
Right? And today, between cash and CPF, I always advocate that you use the lowest interest source to invest. If you got cash sitting in a bank account, $1 million, for example, even smaller amount, 50,000 sitting in the cash bank account, getting 0.5%. Why do you use your OA to invest?
That's
you should
true.
be using cash
That's
to invest.
True. That's
your
true.
OA, you don't invest, right?
Yeah.
So I wouldn't say that everybody should use their OA. It depends on your total wealth. You decide whether you should keep your OA as like a bond and use cash instead. And there are also people whom they don't understand investing. And all they have is really their OA money. I'm quite scared to encourage people to go and use their OA because you and me, we can talk about investing OA and then they buy. Then we are no longer there to advise them if they become scared and they want to sell.
Oh, then they bail out.
Then they bail out, they lose money.
Okay.
Right?
Yep.
So I'm a bit afraid of that. But well, that's the first thing I want to say. The second thing I want to say is this. Like it or not, as much as we are a very close partner with Dimensional, you are still taking fund managers' risk with Dimensional. It's not index. There's a difference, right?
Oh, yes.
So if you don't like fund managers' risk, because fund managers, anything can go wrong, right?
Yeah.
They have done very well since the 80s. David Booth is the chairman.
Sure.
Let's say what happens if he's out of the picture. Let's say what happens if the CEOs go wrong. No, I'm not suggesting they will. I mean, I know the management team. I visit their office every year. I talk to them. Mm-hmm. But what I'm saying is there is always that risk that a fund manager decided to veer away from how they usually do things, right? But if you're investing in an index, you're investing in the index. The only thing that you really want to be worried about, I mean, there are a few things, but the main thing is tracking error.
Sure.
How well are they tracking the index, right?
Sure.
So that's the other thing. No matter what, no matter how good Dimensional has been, you are still taking fund managers' risk. Now, if you don't like fund managers' risk, then you should just go and buy an index, buy an ETF. Now, we have been working with Dimensional since 2016. They came into Singapore in 2014. And I've shared this a few times. I started looking for a low-cost option in Singapore in 2004. I've spoken to Vanguard 4 times. Literally begged them to bring
They came for a while, right?
They never came at all.
Okay.
Okay, the first time, they said nobody will sell it, so no. Second time, no. Third time, the third CEO, no. 3 CEO. The last CEO, Mr. Richard Wayne, said yes. They almost brought it in. They registered already, okay? But just before they rolled it out, headquarters came down and say close the office in Singapore. They are now totally out of Asia. So we don't have a low-cost option. And I think listeners must realize why. Singapore is a very small market.
Yeah.
Sometimes we think we live in our own bubble. We think that we are very big, right?
Sure.
But actually we are very, very small. When a huge fund house wants to come to Singapore, they want to look at business potential. Yeah. We are so small. Firstly, we are very small already. Secondly, most financial advisors don't want to sell a low-trail fund, a no-trail fund, right? So it's not easy to get a Dimensional to come in. So in 2014, then the first CEO, Dr. Peng Chen, now our senior advisor, when he first came to Singapore, he came to look for us because Dimensional traditionally only work with fee-only firm. And they asked Provident whether we will carry if they come. I said, please come, we will carry. So we started carrying since day one when they register in 2016.
Yeah, that's how I bought from you. Yeah.
And we are big believer in what they do. But I want to just caveat this and say, you are still taking fund managers' risk. With us, we meet them every quarter just to make sure that they continue to do what they say they will do. I go there every year to meet up with the management just to make sure
Where's that?
Austin, Texas.
Austin, Texas.
Austin, Texas. Yeah, they have a second office in Charlotte.
Okay.
So I'm going this year again, right? But if you just buy it on your own, you need to know that you are taking some fund managers' risk. I just want to say that. And if you don't like that, okay, then just go and buy an index.
Okay, very good. Now I'm going to ask more commonly asked questions. Stock picking. Are you a believer of it? Do you do it?
I don't know how to do it.
You also don't know how to do?
I don't know how to do.
You so big shot also don't know how to do?
I do.
Hey, hello.
All lose money.
You're as good as him not? Okay? You're as good as him not?
God.
You're like
many people
80% of y'all keep saying, I'm very good at stock picking. He also don't know how to do. I also don't know how to do. Y'all must be very smart. Know how to do. Okay.
Even last 20 years, Warren Buffett lost to the S&P500.
Is it?
It's a fact, yes.
He lost, man?
Yes.
I thought it was 20%.
No, Berkshire Hathaway couldn't beat the S&P 500 the last 20 years. I mean, I dare to say here, obviously, it's factual, right?
Sure.
And who am I to go and pick stocks? That's one. Secondly, I'm a finance grad.
Okay.
I passed exam.
You what?
I pass exam.
Okay, pass exam.
But I don't know how to pick stocks.
Really?
I don't know how.
You also don't know.
Because, I mean,
No lah. They always say look at PE ratio, return on equity, draw chart. When the line cross this line, when the cross this line, something like that, you buy.
yeah,
and
that's technical analysis.
yeah, everything all together. And then sometimes they look at the sky, look at the moon. I don't know how they do it.
In the army, you say,
Yeah.
I don't know, honestly, I don't know how many of these people can consistently beat the market for a long period of time, because even Warren Buffett can't do it, right? But for me, it's not just a matter of, I know I'm not good at it. The more important thing is that I don't have time. I don't have time to go and pick and monitor. And the third thing is, I'm not greedy. Why do I pick stocks? I pick stock, or in our finance term, it's called security selection. You do security selection because you believe that you are able to find mispriced stocks, and you are able to get better returns than the market, which is called alpha, right? But what if I don't need alpha?
Who don't need more money? Everyone want more money.
There's a trade-off. What if I don't need? Because I don't want to do the trade-off. I think
Sure.
whatever the market gives me,
Sure, it's good enough.
it's good enough. Plus, it has a higher probability of success.
That's the key thing. Higher probability of success. Okay, that's a good word.
Which is our approach at Provident. We always say that we find the approach that gives you the higher probability of success. Granted, if there are people who say they can beat the market, good for them.
Have you seen them?
I mean, I've heard them, but I've never looked at whether they really have done it consistently, right? Granted, there are people who can do it. I'm not sure they can do it consistently, but if I'm managing my clients' money, and it's their serious money, it's their retirement money, it's the money that they cannot lose, I need to find a way that gives you the higher probability of success. And from evidence, stock picking doesn't suggest that. So I don't want to do that.
I see. Okay.
Yeah. So that's the reason why I don't pick stocks.
So now we segue. Okay, buy index, right? I actually believe in crash buying. That's me. But a lot of people say, Mr. Lu, this crash buying thing, very difficult. Crash that time, everybody feel like dying. You can buy, right? So let's assume that. And then they also say, how you catch a bottom and things like that. That's a different thing altogether. So, but for most people, they say dollar cost averaging. But they start dollar cost averaging when the market is shooting sky high. Then they start dollar cost averaging. And after a while, we see that happening again. Then market start going down. They stop the dollar cost averaging, right? And then they restart again when the market going up again, right? So the human emotion disturb the investment pattern and all things. Very very kanko. What is your best advice? Knowing. Must be practical. The textbook say this, do this, do this. But actually, what actually works? What's your best advice for most people?
I ask you, when you say you believe in crash buying, right? Do you still buy when there's no crash?
No.
So you only keep until
you just accumulate,
and then you crash.
And then when the market low side the time, okay. And then when the people prepare to flush the toilet, then I go and throw.
So at what level do you then define it as a crash? 10% from the last peak? How do you do it for you?
It case by case for my case. When I look at the market, the macroeconomic signal, I'm not saying that I'm right all the time.
Yeah.
I roughly can catch 5-10% of the bottom. But I read the macroeconomic signal and like for example, like the 2022 crash, when I start seeing all the commodity prices start stabilizing and then potentially going up, so I feel that CPI is hit the bottom already, So I whack. So it's very case by case. But that's playing to advantage because I'm a economist by blood, by training, and also my hobby and things like that. Will I be always right? I don't think so. Okay. But you don't need to be the bottom. Let's say it crashed by 30%. If I hit at 20%, I just whack all in and just go live my life. So 2022 was the year I did my hair transplant. I did my skin. So I was very distracted over all this. So it's very good, play to my strength, right? But I find that a lot of people can't do what I do.
Yeah.
and not that much better, because that only give you a 20% uplift only. It's not a lot. Dollar cost averaging require a lot of consistency, which
Discipline.
I don't have. Discipline, which I don't have. So like what you say, you don't have time. And if I automate a process, I always have very doubt. I press the button wrongly, key in the wrong number, that kind of thing. So no faith in myself and the system. So that's why I ask you, in practice, how many, what is the best advice you can give people?
Yeah. So you see, the key difference between you and me is that you are investing for yourself.
Yes.
You make the call yourself. Right?
For myself, yes.
Yeah. For me, I don't just make investment for myself. I make investment. I mean, currently we manage about slightly more than 1.2 billion of our clients' money.
1.2 billion.
It's not my
he
money.
call himself small business.
It's not my money.
1.2 billion, almost all his money lah. Anyway, yeah. I mean, he manages, but
you got 10% of that one.
Yeah, he keep thinking. Then next time he's gonna do 20% of that. Okay, anyway,
You got 10%. It's not bad. Mine is not my money. It's the client's money.
Yeah.
Now I review how much you really have already. Okay, so anyway, when I make decision for investor, it's quite different. Again, I go back to this. At Provident, because we manage for our clients, I must find an approach that gives them the highest probability of success, because I'm not managing my money, right? If I make a mistake, I cannot go to my 900 families of clients and I'm sorry, I make a mistake, right? But if this is my own money, I make a mistake, too bad, right? I'm responsible for it, right?
Yeah.
So I can't do that. I have to find the approach that gives the highest probability of success. And from evidence, it is not easy to consistently beat the market by guessing when is the time it crash and go in, right? So that's not the approach that gives the highest probability. So what we do, and I do personally, because I follow what my company preaches, is that I don't want to try and guess when the crash will be. If I do that, for example, the last huge crash before the 2022, 2018 was a bad year, 2022 was a bad year. There was a crash in 2000 March, the S&P500 dropped by 30%. But before that, if you remember, and I'm sure you remember, was a GFC of 2008.
Oh, the one outside.
That one you jialat, right?
Oh, 50%.
So that was a big one, right?
Yeah.
And then 6 months later, because the subprime started in 2007.
Yeah.
Okay, but when the big crash came and Lehman Brothers all came down and all that, that was September 2008. And then 6 months later, in April of 2009, the market came back. And it continued to go up all the way until 2018, it dropped, but it's not a crash. Okay, and then 2020...
COVID.
Yes, and then the S&P 500 dropped 30% one month, but then it recovered very quickly.
Super fast.
And then 2022 was a bad one.
Was a bad one.
So if I had waited for that crash, I would have missed 10 years of bull run from the market.
That is true.
So I didn't, and we don't do that for our clients as well. So what we do is we invest regularly. Okay.
DCA?
Depends. Okay. Not every client has got 2 million to
His
invest.
number keep going up and down.
I stuck to 2 million. Okay. But joke aside, not many people have lump sum. They are 打工仔. So they may not have the lump sum, but they can invest regularly. Now, evidence shows that lump sum investment beats DCA. Why? Because the market goes up in the long run. If the market goes up in the long run, you DCA for the long run, you're buying more and more expensive.
Yeah.
Right? So lump sum, in terms, theoretically, it does better than DCA.
Okay, when we say lump sum, you lump sum at the wrong time, you also you lump sum right at the peak of 2007, went down to 50%.
But by today, it's up already.
That's true.
Right? So if you are investing, that's why the time horizon is very important, right?
Okay.
So if you buy at a peak just before the crash of September 2008, you enter, let's say is August of 2008, you cry for 6 months, right? And then after that, it starts to recover. And even though it started to recover, you still haven't make up your loss. But then if you stuck on with it, right, by today, you would have made 200%.
Yeah, 200%.
Right?
Yeah.
So the idea is that even if you invest at the wrong time, lump sum is better than DCA.
So when you say lump sum is ului the hood local, I see something like that.
Yes, okay, you can say that.
Yeah.
I pause for a while because there are some investors, right? They are retiree, and they got lump sum, right? They are no longer working. They don't have DCA. When they put in one lump sum, they actually tend to do better in the long run because the market goes up in the long run, right? But my point here is that, firstly, not everybody got a lump sum. Secondly, not everybody can take what could tip curve. Then after that crash, then I take it, no, then I don't get out. Not everybody can do it. Yes. So DCA becomes more palatable. Dollar cost averaging becomes more palatable because it allows you to stay invested. And even though you do not as good as lump sum, but you still get the return. The key here is not to... It is very difficult for you to beat everybody and be the number one guy that get the best. It's not possible.
Yeah.
Most importantly is 高价啦. You get the return is enough for you.
Return enough 就够了. That's I think the key lessons from here.
Yeah, because ultimately the purpose of money is to enable your goal, ma.
Yeah.
Right? Okay, so back to your question. Well, so what we do is that we invest regularly for our clients, but we ask clients if they can, okay, have some dry powder when the market crash.
Huluk.
Put in. But it's not to go in, go out one. You put in, you stay invested.
Like me,
Yes.
Okay.
Okay. Now.
But how you advise them?
Where
to go down? Where to put?
It's the same portfolio.
Okay.
Yeah, we diversify.
No, when? Sorry, when?
So for us, we have a guide.
Okay.
So like we will like look at either the S&P500, MSCI All Country as a guide. So when the market dropped 10% from the peak, we ask them to put certain percentage of their dry powder in.
Sure.
Then if it drops another 10, put a bit more. Drop another 10, we put a bit more. Okay. Why like that? Because we did a study on the crashes in history. To drop 30% from the peak, the probability is very low.
Rare.
Yeah, so you cannot wait until 30 because you can wait to never come, right?
Yeah.
So when it drop 10, you can put in a bit. Next 10, you put in a bit. So what we do is, of course, for our clients, right, we activate. We tell them, remember, we told you to have some dry powder, and when the market crash, this is the time. Deploy. Then they deploy. No? Now the main purpose, I have to say this, is not to beat the market. The main purpose is to be a psychological cushion, because when the market drop, you got no money to buy, you don't feel good.
Yeah.
You feel scared. But actually, if you've been investing regularly, the market drop, you buy some. It doesn't matter how much. You buy $5,000 or so, you feel good.
Yeah, you feel shocked.
You feel happy. You go around telling people, I'm in the market, right? But when you tell a person, I got no more money, the fellow feel very sad, right?
Yeah.
But when you can put in a bit like that, it gives you more courage to actually stay invested for the longer term. So we do it for that purpose, not to get a better return.
Not really to help them make more money.
No.
It's to help them feel consistent and comfortable in the market.
That's right. If you want to make a lot of money,
Such wisdom.
You then have to really buy only when crash lah. Then you get it right, then you boom down Charlie lor, right? But our way, we will make you the best return, but we are confident that you will get the return you need. And then when markets are down, put in some money just to make yourself feel happy, and then you have the ability to stay invested.
So down 10%, put in some. Down 20%, put in some. Down 30% is very rare. Whatever the kind of thing. Some around that.
Yeah, there's a part.
So much wisdom, right? Yeah, so much wisdom. Okay, so all said and done. Chris, how do you invest your $50 million spare cash that you have?